All right, so we got another educational video today, PD arrays. We're gonna be talking about PD arrays today. PD arrays, what are they, how to use them, all that good stuff. So PD arrays, also what they stand for is premium and discount arrays. So in simple terms, a PD array is anything that can push price from a premium to a discount of the range that we are currently in, right? This can be something like a fair value gap, FEG, imbalance, inefficiency, whatever you want to call it. It could be an order block. A PD array can be a breaker block. A PD array could also be something like a mitigation block. And there's a lot of other examples, but these are what I'm going to go over in this part. I'm going to probably try to break this up into a few parts just because they can go pretty in depth. So let's start with fair value gaps. So starting with fair value gaps. Fair value gaps are the easiest ones to spot, not necessarily use, but they're easy to spot because they're simply a 3-candle pattern. Any 3 candles that represent this pattern form a fair value gap. It is 3 candles where the wicks of the first and the second don't overlap. So for example, we just created a fair value gap right here. Here's candle number 1, candle number 2, and candle number 3, right? These make a fair value gap because the wick of the first candle and the second candle don't overlap. Now, these fair value gaps, what they represent is a strong move in one direction in the market, and the market likes to rebalance them because they're viewed as imbalances in the market where price only traded one way really strongly. So the market likes to return to these areas to rebalance it and then continue the move. A few examples of this would be right here. Right, we have this fair value gap. You can see the market digs all the way into it, all the way even down further into this fair value gap down here before rejecting them and then moving higher. Another example is right here. Here's a fair value gap that got held and respected multiple times before we got the move up. And you can find countless examples, both bullish and bearish. We'll drop to a lower time frame to find some bearish examples because we're making an all-time highs run right now, so not a lot of bearish examples on the higher time frame. If you want to use bearish examples, we can see this fair value gap here, but this is not the one that got held respected. The one we're looking for to get respected would be this one here, right? We pull back up into this fair value gap, into this imbalance, and it gets respected, and we continue to push for this low here. This is just the first candle, second candle, third candle, where the first and third candle, their wicks don't overlap, leaving a gap being made by the second candle. So go through your charts, try to find a few of these. They're pretty easy to spot, and there's like endless examples. They're all over the place. So we'll get more in depth on how to use them in a bit, but right now we'll move on to order blocks. Order blocks are the candles or the move, like the continuous candles along each other that took out liquidity or filled a fair value gap. So just to highlight one right now for your eyes, this right here is an order block. Sorry. This candle is an order block. This candle filled the fair value gap. And then once we closed above it, once we close above the down closed candle, right, it has to be the opposing color, right, this bearish candle. Once we close above it, after we rebalance the fair value gap, that's what confirms it as an order block. This closure above it is called a CISD. Also stands for change in state of delivery. Once you get this closure above it, this change in state of delivery, where the state of delivery goes from being sell side, bearish, to bullish, this becomes an order block. And they are similar to fair value gaps where the market will come back and dig into them before continuing the move because they are the same way the fair value gap is an imbalance. When the market was trading in the fair value gap, they were discounted prices in the market. So the market will come back to these discounted prices and use them to move higher. So find a few more examples right now. I'm actually going to zoom out for a second and just test you, see if you can find out where it is. I'll highlight the liquidity that the leg swept out, and then you'll tell me where the order block was. So here's all the liquidity that this leg swept out. Where in here is the order block? All right, so if you said it would be this candle here, this 8:30 candle, that would be right. And also it can look different on different time frames, but I'll show that in a second. So this order block, once we close above it, right, we close above here, this becomes a change in state of delivery. We dig back into this order block, and then we reject it and continue the move higher. So I said they can look different on different time frames. That's because on the 5-minute time frame, you can start to align these PD arrays. The order block would be these candles here, because it was this sequence of candles on a lower time frame. You know, it was bearish candles, black candles, down candles that ran out all this liquidity. So once we close above them, this becomes our, once again, change in state of delivery, CISD, and then we tap it and we go. What else do you see paired with this order block? This fair value gap here, right? So this becomes a stronger area where we can look to take a long from. Now we'll look for a few bearish examples. Now you might be able to see a few, but I want to see if you guys can tell where the bearish order block is. I'll give you a clue. It's somewhere in the middle of the screen here. So if you look at this fair value gap that we have here, and then this high that we have here, you can see this high hit the fair value gap and swept that high. So the up closed candle, the bullish candle that gets closed below, as soon as it gets closed below, this becomes our change in state of delivery, CISD. And you can see the next time that we refer back to this price, we continue to move lower to take out the sell side liquidity. So this becomes our bearish order block. Once we close above the, close below the body or the wick of it, and we continue the bearish move. Blocks, breaker blocks, and mitigation blocks all kind of have the same concept to them, where the market dug into a discounted level and then blasted higher into a premium, or dug into a premium level and then pushed lower into a discount. So they are kind of easy to confuse, but we'll go over breaker blocks now, and I'll try to explain it pretty simply so that you can understand it. So breaker blocks are the pattern that a breaker forms is a 4-point pattern. You have point A, point B, point C, and point D. And the breaker block forms from point A to point B. This is your breaker here. The breaker is a low, high, lower, low, higher, high formation where C runs out A and D displaces strongly and closes above B. The next time we revisit B, point B, anywhere in this leg, if we are bullish, you can expect a continuation out of it. And this is where your uptrend, this is where your uptrend starts to play. So now in a bearish example would be if you have a high, low, higher high, lower low, and then your breaker would form here. And it's still the same concept. C runs A, and D displaces and closes through B. So when C runs out A, you see this as a liquidity sweep. It just came to take liquidity because we're in a downtrend or we're bearish. But when D takes B, I'll letter it so it's easier. A, B, C, and D. When D takes out the B, you were not expecting it to just sweep it the way C took out A. You were expecting it to completely close through it, and this is where you find your market structure shift, break in structure, shift in market structure, whatever you want to call it, change in character. It's not just a little sweep like this, it's a closure through it, and you want to see it close strongly through it so that it revisits B, and this becomes a reason and gives the market intention to move back lower. Now here is a very good example of a bullish breaker. You can see we have the A and B leg, B to C leg, and C to D leg. Now notice how when C takes A, it is just a sweep, a very quick sweep. We wick it, no closures below. We actually still respect this for a value gap the whole time. We don't close below it. Very, very obvious liquidity sweep, as where when the D leg takes B, we close through it and we don't slow down once we take the high. Going up a time frame, you can see the aggression that we close through the B leg. So this is an example of a bullish breaker block. Your breaker block would be, you could say technically this whole leg, but it's more specifically this candle here that's being used as support. Block is very, very similar to your breaker block. The only difference is that it will make a failure swing instead of a liquidity sweep. What a failure swing means is just a high or low that failed to take the previous one. So this would be a failure swing, where if it had taken the high and swept it, that would be a sweep. Right? Failure swing is just a failure to make a swing high or low. Your mitigation block would just be here. That's all the difference. This would be a breaker, mitigation, breaker, mitigation. Now, very, in my opinion, overcomplicated, no need for another classification of a PD array, but this is the way that it's taught, and they are very similar. And most of the time, you will see a mitigation form after a breaker. For example, we form a bearish breaker. I guess I didn't really need this. We form a bearish breaker. Once we make this bearish breaker, when we come back into it and then redeliver again, this right here becomes the mitigation block. Here's the mitigation block, and here is your breaker. So it just follows the market structure, just like that. So that is a wrap on the identification of these 4 PD arrays. This is just how you can spot them in the market. I'll go way more in depth in how to structure them together, their importance at different levels in a premium versus a discount, and how they align together to form a model. But this is just how to see them. I would practice going through the charts to look at these PD arrays, because it'll eventually become just second nature, and you won't even have to like focus on it to see it. Your eyes will just adapt, and you get this like muscle memory inside of your brain of seeing these PD arrays form, and it just becomes super second nature. You don't really have to think about it twice to say like, oh, high, low, higher, high, lower, low, this is a breaker. It'll just all happen subconsciously. So that's the level you want to get at. So I would just take a minute to, or take your sweet time and go through the charts and identify these PD arrays that we talked about. I also, of course, I hope you guys find this video helpful as well. And if you have any questions, you leave them anywhere. I'll see them: Discord, TikTok, YouTube. I'll try to get back to as many as I can. And hopefully this was helpful and you can start to understand how to find these PD arrays better, and we'll move on from here. So good luck.